I've spent the last 38 years of my life in the financial industry. I've experienced both the incredible highs and the disastrous lows of the stock market. Investing is tricky, and the stock market is complex. But I have adopted 7 key rules about the market, and I want to share them with you today. Being aware of these 7 rules, you can better understand the forces that drive the markets up and down and make more informed financial decisions for yourself and your loved ones. First, time horizon defines the level of risk you can take. It is a proven fact that the longer your holding period in an investment, the greater your odds of a positive return. The chart here shows the probability of accruing positive returns by investing in the stock market over various holding periods from short to long. If your holding period is a month, your probability of a positive return is 63%. Or said another way, you have a 37% chance of losing money. If your time horizon is 10 years, a very typical time horizon for most equity investors, your probability of a positive return rises to 97.4%. Or said another way, you have a less than 3% chance of losing money. If you are a pre-retiree contemplating retirement in 3 years, should the markets decline just prior to your retirement, about a 12% probability, you have a very little chance of a do-over. As your time horizon decreases, you need to adjust your asset allocation to reduce the volatility of your portfolio. More on asset allocation in just a bit. Second, time in the market is what matters, not market timing. While it may be tempting to sit out market volatility by moving into cash, research has shown that it is almost always a bad idea, because sharp market declines are usually followed by market rallies, and there is a big price to be paid for missing the recoveries. For instance, if you invested $10,000 in the stock market at the beginning of 1980 and held that investment through the end of 2024, your investment grew to about $1.7 million. If you missed the 10 best days during this period, your investment grew to only about $763,000. In other words, you gave up $945,000 because of your botched market timing strategy. Third, compound interest is an amazing thing. Albert Einstein described compound interest as the 8th wonder of the world. The math associated with returns, growing on returns, can be mind-boggling. For instance, a modest 6% return on an investment held over 12 years doubles your money. Or described another way, gives you a 100% return because of compound interest, not 72%, which simple interest would yield. Of course, compound interest has a dark side too. This is clearly evident when investing in volatile asset classes such as crypto, commodities, penny stocks, etc. If you lose 10% in one period, you need to make 11% to get back to break even. Taking this example further, a 20% decline in an investment needs a 25% return to break even. A jaw-dropping 50% decline would need a meteoric 100% return to get back to where you started. Number 4, proper asset allocation can reduce volatility and increase predictability. Assets don't always move in unison, and this characteristic can be invaluable in building a diversified portfolio. A diversified portfolio delivers a good balance of return and reduced volatility. For instance, a portfolio comprised solely of stocks would typically have a range of annual returns between plus 38% and minus 41%, with an average return of 12%. But a portfolio of 60% stocks, 40% bonds would range in performance from plus 30 to minus 24, with an average return of 9.5%. As you can see, diversification reduced the spread of returns from 79% to 54%, or reduced the volatility by almost 1/3. If you are approaching or are in retirement, you need to add more predictability to your portfolio through asset allocation. Number 5, Stock prices follow earnings growth over the long run. If you look at a chart of the S&P 500 and overlay the earnings growth of the companies in the S&P 500 index, you can see that stock prices closely track earnings over the long run. The median annual growth rate of the S&P 500 earnings is close to 10.3% over the last 30 years. Not surprisingly, close to the S&P 500 average annual growth of 10.4%. Earnings are the proverbial lifeblood of the markets and the biggest driver of stock prices over the long run. Number 6, valuations do matter and often revert to the mean. There is a saying in our business that any investment is a buy at a certain price, and that same investment can be a sell at a higher price. Contrary to what the academics will tell you about markets being efficient and that prices reflect all available information, in my 3 decades in the investment business, I have often seen instances where the information is evident, but investors don't acknowledge and act on that information. We use a ratio called price to earnings, or PE ratio, to measure the valuation of the market. Essentially, it's a measure of how much investors are willing to pay for every dollar of earnings per share a company generates. There have been times, such as 2000, where the statistic indicated high valuations, and the market subsequently corrected. Under the surface of the statistics, some stocks and sector valuations periodically go to extremes, and the valuations revert to the mean. On the other hand, times such as early 2009, after the global financial crisis, stocks were cheap and bottomed in early March to rally strongly. I should caution that extreme valuations are a good directional tool, but are not the best market timing tool. And finally, extremes in sentiment often indicate turning points in the market. Warren Buffett, one of the most successful investors of our time, has a saying, "Be fearful when others are greedy, and greedy when others are fearful." This is very true of the markets. Sentiment is often a very good market timing indicator. There is a whole branch of finance devoted to this dynamic called behavioral finance. Euphoria, greed, and irrational risk-taking often precede market downturns. And by the same token, despondency, fear, and irrational risk aversion are indicative of market bottoms. As you can see from the chart, extremes in sentiment have preceded market inflection points such as 1990, 2000, 2008, 2009, 2020, and 2022. In closing, I'd like to end by quoting Warren Buffett again, that in the short run, the markets are a voting machine, but in the long run, they're a weighing machine. In other words, true intrinsic value of an investment prevails. But the prices investors pay, also known as price discovery, can fluctuate above and below that value. Remember, the markets have often experienced shocks such as the dot-com bubble bursting in 2000, the 9/11 attacks, and the COVID pandemic. But these downdrafts are usually temporary, and factors such as valuation and earnings growth prevail. It pays not to bet against the market, and working with a financial advisor to help you navigate the market's complexities could pay dividends in the long run. My colleague Jared Kenny just released this video outlining the results of a recent financial advisor study. And, spoiler alert, an advisor can help you drastically increase your net worth over the long term. Click here to watch, and thank you for listening.